So what exactly is buy-side and sell-side liquidity, and where does it form in the market? To understand this clearly, we need to look at how price behaves inside a range and how liquidity builds before a major move. When price moves within a consolidation or any structured phase in the market, it often forms visible reference points such as equal highs, equal lows, trendline touches, or repeated reaction areas before the next major move begins, whether that is continuation or reversal. Within these structures, we typically observe zones where price consistently reacts, forming areas of support below and resistance above. Retail traders typically look to buy when price approaches a lower boundary or a perceived support area, placing their stop losses just below it. This creates a concentration of orders beneath that zone, made up of the stop losses of buyers, ready to be triggered. In addition, it often includes sell stop orders from traders expecting a breakdown, believing price will continue lower once that level is taken. On the opposite side, when price approaches an upper boundary or a perceived resistance area, many retail traders look to sell, placing their stop losses above it. At the same time, buy stop orders begin to accumulate from traders expecting a breakout. This creates another concentration of orders above the structure, with multiple types of positions clustered in the same area. Therefore, buy-side and sell-side liquidity do not exist only at traditional support and resistance levels. They form wherever there is a concentration of orders in the market. Buy-side liquidity refers to areas where buy orders are clustered, often above highs or key reference points, while sell-side liquidity refers to areas where sell orders are clustered, typically below lows or areas where traders expect breakdowns. Now, let's take a closer look at how buy-side and sell-side liquidity appear in the market through what we call static liquidity. Static liquidity refers to specific areas in the market where a large concentration of orders is resting, including stop losses as well as buy and sell orders waiting to be triggered. When a trader gets stopped out of a position, the market absorbs the orders associated with that stop. This is part of how liquidity is created and taken from the market, allowing price to continue moving. The idea is simple. The market requires liquidity to generate movement. If price does not interact with liquidity before reaching a key level, it will often use that area itself as a source of liquidity to fuel the next move. Static liquidity can be identified in various areas on the chart, such as below equal lows and above equal highs, above swing highs and below swing lows, around trend lines and channels, and within other important reference areas where traders tend to place their orders. These also include commonly observed zones, such as support and resistance, Fibonacci levels, and key regions within a candle structure. What matters is not the tool itself, but the fact that many traders are making decisions around those same levels. Having a clear understanding of these liquidity zones highlights how strongly they influence price movement. Some of these areas become especially important because they are widely recognized, attracting more stop losses and pending orders, which increases the probability of price moving toward them. Next, we examine how the market responds when it approaches these zones. Suppose price is moving toward a visible area where many orders are likely to be resting, and traders begin positioning themselves based on that expectation. If price pushes beyond that level, it triggers those orders, creating a surge in activity as positions are forced to execute. This reaction generates momentum and often leads to a sharp movement as liquidity is being taken from that area. These behaviors can appear in any type of market structure. The key idea is not the specific pattern, but the presence of clustered orders. Understanding where these concentrations form allows traders to better interpret price movement and anticipate how the market may react when those areas are reached. In simple terms, the market moves from one area of liquidity to another, driven by orders being triggered and absorbed. By understanding buy-side and sell-side liquidity, you begin to see the market as an interaction between buyers and sellers. So trader, please remember that the ComLucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.